on the moment we're in with our technology. He is in Chicago. Anurag Rana joins us, senior tech analyst at Bloomberg Intelligence. Anurag, the depth of COVID, Microsoft printed $45 billion of net income. Last year, they did $102 billion, more than double from the depths of COVID to where we are now. Is their net income in any way, shape, or form at risk?
See, over the next couple of years, it is at risk of the investments that they're making. But, think of a compounding point of view. That's just going to bring in more revenue and more profit down the road. So even if there is a little blip over the next couple of years, we think the long-term prospects are both much better than they were before during the COVID time because of the infrastructure that they are building for AI workloads.
So, Anurag, I think if I can frame it out here, what's been happening in the sell-off of software stocks over the last several weeks and months has been AI is going to displace many of the software services that have been so beneficial to so many people. Just for an example, Salesforce.com, that might be at risk from an AI application. So just from that 30,000-foot level, how do you frame out the risk to software, if any, from AI?
Yeah, Paul, that's a very good question. And there are two kinds of sell-offs right now. One is the sell-off of Microsoft, which is about CapEx driven, or Amazon Web Services CapEx driven. And the second bigger sell-off is all these software companies that are at risk of being disrupted by AI, because I could do vibe coding and do that internally. Now, we have a very different view on that point. We think the companies that are core critical systems of records and that sell into large enterprises are a lot less prone to this disruption than somebody that's selling a very low-end software to smaller businesses. The reason we think that is because these systems of record, stuff that's sold by the likes of SAP, Workday, ServiceNow, Salesforce.com, is because those are critical to the running of an organization. And frankly speaking, we don't see these large companies just getting rid of them, just to save a little bit of money.
So what are the companies saying, like the Salesforce.com and the other SaaS companies? What are they saying about their order book? What are they saying about kind of the short, intermediate, and maybe long-term threat from AI? How are they framing it out?
Yeah, so the long-term threat is about the terminal value of it. And, this is the most fun argument. If you say, well, this company is not going to be in existence 10 years from now, and we all know that 75% of the value of a firm believes in the terminal value, then there is there's not a whole lot you can argue against. These companies are still growing. They're growing at a slightly slower pace, but that has nothing to do with AI disruption. That's just the macro environment where their clients, the Fortune 2000s, are not hiring at that same pace. So they are not able to sell the same level of licenses. They're still growing 10%, 12%. In the case of ServiceNow, above 15%. But that's not what people are seeing. They're basically saying this thing is going to be destroyed down the road.
Bloomberg fixed income expert Anurag Rana with us for Across the Nation and Worldwide. Thank you for joining us. On YouTube, subscribe to Bloomberg Podcasts. You can do that. This is the first time I've done this, Anurag. The Google 6 1/8 of 2013, 21.26. It's gone up 3 days in a row. It's still at a 100.73, slight premium as well. From where you sit, is Microsoft like a lemming on the cliff? Do they just do a bond deal like Google?
See, I don't think they don't need to do a bond deal at this point, or at least that's what we think. So, only because they are spending a lot of operating cash flow. Now, the question is, when they are spending a whole lot of capex.
Anurag, I'm sorry. They called up Nuveen in Chicago, right? And,
sure.
And the skyscraper next door, and they said, "Bye. We got to come back with Anurag Rana on this." So, Paul, a 100-year bond?
Yeah.
Google?
Why not? Why not?
I mean, the University of Oxford and others. I get it, but and it's traded up 3 days in a row.
Yeah,
unbelievable. We switched from 100-year bonds to the opening of the stock market. Joining us, Bloomberg Surveillance's Alexis Christoforous.
And ahead of a long holiday weekend, we are looking to recover from yesterday's big sell-off. And as we see the numbers starting to come in, the Dow Jones Industrial Average is down about 18 points. We've got the S&P 500 in the green by about 2, and the NASDAQ Composite is now down 18 points. Russell 2000, though, up just about 5 right now. Elsewhere, the Bloomberg Dollar Spot Index slightly weaker at 1182.10. Japanese yen a bit weaker as well, 152.89 against the U.S. dollar. Yields are lower with the 2-year at 3.41%, 10-year 4.06%. We've got spot gold right at $5,000 an ounce at the moment, and Brent crude 67.48 the barrel. So once again, mixed opening on Wall Street as traders react to a tame inflation report for the month of January. That's your Bloomberg Business Flash, guys.
Thanks so much. Anurag Rana with us here, Bloomberg Intelligence on the cloud. And so I got like 8 ways to go here, Anurag. Paul wants to get in here quickly here then. I mean, all the money that Microsoft is going to spend, what are they going to spend it on?
So right now they are adding more and more GPUs to their network. So they have a very large cloud platform, as we know, called Azure. But those are the usually with CPUs and the older technology. The next generation data centers they are coming up with are the ones that have the latest chips out there. And they're doing it for 2 reasons. They do see an order book where the demand from their client base is very high. And that's what you need to run those workloads. They actually have a bigger backlog than what they can realize in revenue right now. One of the things the management said on the call was the growth rate of Azure would have been above 40% if it wasn't for the lack of GPUs. So the big difference for us is that between them and the neo clouds is even if down the road we see a tapering of demand on AI workloads, they can still utilize that for their legacy, cloud products, their internal research reasons. So we don't see that this is going to be the case that they are spending a whole lot of money and the revenue is not going to follow them.
Anurag, are these Salesforce, particularly the Salesforce as a service stocks, are they being re-rated down? Is valuation being permanently compressed a little bit? I see that Salesforce.com is roughly 4 times revenue. What's going on out there in terms of valuation?
So, Paul, this is like, the classic case of extreme fear in the market that the business model for these companies is not going to be relevant. And we made a case, I think, for the last 3 months that that's not the case. But every time we write something, next week, they'd go down another 5 to 10%.
Killed it. You've done great, Anurag.
So, look at a company like SAP, for example. They've been in around business for 50 years. They are the hearts and lungs of most large companies. Your financial system works on it. Your general ledger works on it. I see very low likelihood that somebody is going to wipe code their way and let a CFO sign off on a 10K or a 10Q based on, something that an LLM produces. So, for us, the disruption on the large enterprise side is a very low probability. Now, if tomorrow Claude or Anthropic is able to come up with an AI product that sells to the small and medium enterprise, that does make sense to us. But for these larger companies, I think they have a better moat than people are expecting right now.
So what's the play here? Is it to try to identify the best names out there, the ones that have been sold off the most? What do you think some of the smart tech investors are doing today?
I think they should be looking at and says how difficult it is to rip off a software package from a company. And that's where we think the bigger guys with a high market share, as I mentioned, ServiceNow is a company that has 40% market share in IT service management software area. Salesforce has 40% market share in customer service and sales automation. It's not going to be easy to get rid of those, but the really small vendors, they are, I think, at the risk of losing out.
I mean, Anurag, in our New York World headquarters, we don't have an office called Lenny Dykstra. You're in Chicago, and I can see behind you on YouTube the office Wrigleyville. Do you have an office called Comiskey Park?
No, there is a Lincoln Park, there is Hyde Park.
In Wrigleyville.
Yeah, that's how they go. Chicago, nice office out there.
We should do a road trip. It'd actually be great. Bring Mandeep Singh with us.
Sure, I've heard of him.
Mandeep Singh and Anurag Rana together in the same room.
Tech talk.
Too much. Anurag Rana, a jewel of Bloomberg Intelligence.